Hello, everybody. I'm delighted to be with you today to continue our discussion of cryptocurrency regulation. Today's webinar is the final webinar of this 7-part series, which is focused on crypto regulation in Hong Kong and how and in what ways it compares with crypto regulation in other jurisdictions. Today, we will conclude the comparative analysis of regulatory approaches to cryptocurrency by looking at Gibraltar, which, like Malta, has taken a progressive approach in regulating this emerging industry, and I'll analyse how this compares to the regulatory approach in Hong Kong. I must also mention that while I'm in Hong Kong and a UK qualified lawyer, I'm not qualified in Gibraltar, and so, as with the other jurisdictions covered in this series, what I say about Gibraltar law is based on my understanding and should not be relied upon. Finally, I will bring the series to a close with a discussion of some notable developments in the crypto sphere recently, with an analysis of how this may impact crypto regulation in Hong Kong going forward. So now I'll begin. Gibraltar. Gibraltar is an example of a jurisdiction which has introduced regulations aimed at attracting blockchain and crypto companies. Gibraltar's approach has been called progressive and right touch, and as a result, the territory has emerged as a jurisdiction of choice for many crypto firms. Let's look at Gibraltar's regulation in some detail and analyse how it compares to the position in Hong Kong. Gibraltar has developed a bespoke regime known as the DLT regulatory framework, which took effect on the 1st of January 2018 and applies to firms that carry on DLT activities. That's activities that are not subject to regulation under any other regulatory framework that use distributed ledger technology, DLT, for the transmission or storage of value belonging to others. The types of activities that require a DLT license include operating a crypto exchange, custodian service providers and asset storage service providers, crypto wallet providers, and operating DLT-based marketplaces that facilitate the buying and selling of goods and services. Firms and activities that are subject to another regulatory framework continue to be regulated under that framework. Firms carrying on a business in DLT activities, including crypto trading exchanges and custodians, need to be authorised and licensed as DLT providers by Gibraltar's Financial Services Commission. There are currently 12 licensed DLT providers, including eToro, Huobi, and Xiaopo. Gibraltar's regulatory approach to DLT is outcome-focused, not prescriptive, requiring DLT providers to comply with 9 principles designed to ensure achievement of desired regulatory outcomes, including investor protection. In their licensing applications, applicants have to demonstrate how they will comply with the 9 principles. The first principle relates to conducting the business with honesty and integrity. The GFSC must be satisfied that the applicant and people associated with the applicant are fit and proper to undertake the relevant DLT activity. The basic elements that the GFSC has set out are honesty, integrity and reputation, skill, competence, care and experience, and financial position. The second principle expects the license applicant to pay due regard to customers' interests and needs and to communicate with its customers in a way which is fair, clear and not misleading. The DLT provider must, among other things, use its best endeavours to mitigate the risks associated with the use of DLT and employ best practices in operating its business. The third principle relates to maintaining adequate financial and non-financial resources. The DLT provider must ensure that it has sufficient financial resources and capital levels, which must both be monitored and be sufficient to support the business objectives. Fourthly, a DLT provider is required to manage and control its business effectively and conduct its business with due skill, care and diligence, including having proper regard to risks to its business and customers, which includes adopting appropriate forward-looking risk management practices. The fifth principle requires DLT providers to have effective arrangements in place for the protection of client assets and money when it is responsible for them. DLT providers are expected to take the necessary precautions to protect asset customers and custodial assets, which need to be segregated from the DLT provider's own assets. The sixth principle requires effective corporate governance arrangements to be put in place. DLT providers must adopt strong corporate governance procedures, which should include board structure, including composition, to ensure that there's a good balance and mix of skills and experience to complement the business. Adequate application of the 4 I's principle, segregation of various functions, cross-checking, double signatures, dual control of assets, and so on, and application of mind and management from Gibraltar. Under the 7th principle, a DLT provider is required to ensure that all systems and security access protocols are maintained to appropriate high standards. The 8th principle relates to the prevention of financial crime. DLT providers are required to have systems in place to prevent, detect, and disclose financial crime risks such as anti-money laundering and counter-terrorist financing. DLT providers must adopt and apply adequate anti-money laundering and counter-terrorist financing preventative measures which are commensurate with their risks, and the DLT providers must also report suspicious transactions when applicable. And under the 9th principle, a DLT provider is required to be resilient and develop contingency plans for the orderly and solvent wind down of its business. On the 12th of January 2021, it was announced that Gibraltar is looking to add a 10th principle to the DLT framework, following the convening of a working group in late 2020. The latest principle will be aimed at defining the appropriate market standards for exchanges operating in the digital asset space and is on track for a prompt delivery. These principles are similar in some way to the terms and conditions which are imposed on virtual asset trading platform operators in Hong Kong under the SFC's current opt-in regime, which covers the safe custody of assets, KYC, AML, CFT, preventing market manipulation and abusive practices, accounting and auditing, risk management, and conflicts of interest. These terms and conditions are also likely to be applied under the proposed regime for licensing exchanges that only trade non-security virtual assets. Gibraltar's principles for licensing are, however, less prescriptive and less restrictive than Hong Kong's terms and conditions. For example, there's no restriction to providing services only to professional investors. On another note, following the implementation of the DLT framework, Gibraltar's Financial Services Commission entered into a cooperation agreement with the Hong Kong Insurance Authority to promote information sharing on innovation and referrals of innovative firms seeking to enter the counterparts market. According to PwC, Gibraltar ranked 3rd in terms of the number of crypto hedge fund managers, behind the US and the UK, with Hong Kong coming in as joint 4th. Gibraltar is also the 4th most popular domicile for crypto hedge funds. Of course, it's still early days, but we can say that Gibraltar has emerged as a leader in this space, not only through its progressive legislative efforts, but also the continued support and development of knowledge and skills relevant to the sector. An example is the establishment of the Gibraltar Association for New Technologies, comprised of Gibraltar's leading law firms, accountancy firms, and tech companies. Gant is tasked not only with enhancing the development of blockchain and DLT, but also raising the profile of new tech. In Hong Kong, we have the FinTech Association of Hong Kong, which has similar goals. However, the association is independent compared to Gibraltar's association, which was launched by the government of Gibraltar. Turning now to AML-CFT regulation in Gibraltar and how it applies to those operating in the crypto sphere. Gibraltar's Proceeds of Crime Act 2015 was amended in 2018 to extend AML-CTF obligations to undertakings that receive proceeds in any form from the sale of tokenized digital assets, whether on their own account or on behalf of another person. Licensed DLT providers are also specifically required to comply with the Proceeds of Crime Act and related guidance issued by the Gibraltar Financial Services Commission. The EU 5th Anti-Money Laundering Directive applies to Gibraltar, and was transposed into the laws of Gibraltar via the Proceeds of Crime Act 2015 Amendment Regulations 2020. The 5 AMLD brought service providers engaged in exchange services between virtual currencies and fiat currencies, as well as custodian wallet providers, into the AML-CTF regulatory regime. However, in 2017, Gibraltar had already regulated these activities. Under the laws of Gibraltar, everyone using DLT to store or transmit value belonging to another person was already within the regulatory scope of the 4th Anti-Money Laundering Directive. Gibraltar has not incorporated the provisions of 5 AMLD relating to providers of crypto exchange services and providers of crypto custodian wallets, since the providers of these activities are already subject to AML and CTF obligations as DLT providers. This is demonstrative of how Gibraltar continues to stay ahead, as while a number of jurisdictions are now developing and enhancing crypto regulatory regimes and imposing or strengthening AML-CFT obligations, as is the case in Hong Kong with the November 2020 FSTB proposal, Gibraltar has had a prescriptive regime in place since 2018. The DLT provider's licensing process takes between a few months to 1 year and includes checks on internal AML-CFT procedures and controls and a risk assessment of the products offered, together with checks on individuals. Now let's look at the regulation of ICOs in Gibraltar. Interestingly, the DLT regulations do not specifically provide for the regulation of ICOs, although they may fall within the scope of existing regulation of securities. Gibraltar issued proposals to regulate ICOs in March 2018. The proposed regulations would cover the promotion and sale of crypto tokens, secondary market platforms, and investment services relating to tokens, and would regulate certain crypto-related activities conducted in or from Gibraltar. The proposed regime would cover virtual assets that fall outside the scope of the DLT regulations and Gibraltar's financial services and securities laws. Importantly, the GFSC has indicated that they do not want to and do not see a place for them as a regulator to prescribe what good looks like in token sales. The GFSC would rather allow the market of authorized sponsors to come up with different options of what a good ICO looks like. As for the position in Hong Kong, a bespoke regulatory regime is not on the cards, certainly not as yet. Instead, regulators have taken a pragmatic approach whereby the SFC determines the regulatory status of ICOs on a case-by-case basis, depending on whether they have features of a traditional security. Where the tokens are considered securities, any party dealing or advising on the tokens must be licensed by or registered with the SFC. This is, of course, a clear divergence from the regulatory position in mainland China, yet is not anywhere near as progressive and proactive as efforts in Gibraltar, which places Hong Kong kind of in the middle of the spectrum of regulatory approaches. So the activities which would be regulated under the proposals, if conducted in or from Gibraltar, include the promotion, sale and distribution of tokens, operating secondary market platforms trading in tokens, and providing investment and ancillary services relating to tokens. The proposals would also introduce a requirement for an authorized sponsor of all publicly offered ICOs and would regulate the conduct of and impose obligations on authorized sponsors, secondary token market operators, that's virtual asset exchanges, and token investment and ancillary service providers. The proposals would not, however, regulate token issuers or promoters, nor the tokens of technology underlying them. Instead, regulation will be effected by requiring authorized sponsors, crypto exchanges, and service providers to comply with new regulations. The aim of the proposed regulatory regime would be to mitigate the risks associated with the relevant activity. In the case of token-based crowdfinancing, this would require full and accurate disclosure of information, while secondary market platforms would be made subject to rules providing for orderly and proper conduct. Providers of investment services would be subject to competence requirements. GFSC will be the relevant supervisory authority for AML CFT regulation, and the provisions of the DLT regulations will apply to firms covered by the new token regulations. The first limb of the proposed regulations would regulate the primary market promotion, sale and distribution of tokens that are not securities, which are already covered under existing securities legislation, as is the case in Hong Kong. Outright gifts or donations, with the regulations extending to activities which purport to be or imply that they are made from Gibraltar, are intended to come to the intention of or be accessed by any person in Gibraltar, are conducted by overseas subsidiaries of Gibraltar registered legal persons. In such cases, the Gibraltar person will be liable, or are conducted by overseas agents and proxies acting on behalf of Gibraltar registered legal persons or on behalf of natural persons ordinarily resident in Gibraltar. In such cases, the Gibraltar person will be liable. According to the proposals, these tokens are typically those referred to as utility or access tokens, which offer commercial products or services which may not exist at the time of the token sale. Tokens that function solely as decentralized virtual currency, for example, Bitcoin, or as central bank issued digital currency, CBDCs, will be excluded from the limb of the regulations. However, hybrid tokens, which have an underlying economic function that is both virtual currency and something else, will be covered. Unless further specifics are included in the proposed regulation or guidance, the current proposals do little to create clarity as to which tokens will be covered by the new legislation and existing securities laws, respectively, and which will remain unregulated. The regulatory treatment of an ICO offering will therefore still require an analysis of the nature of the rights attached to the tokens and their intended use. The Gibraltar regulators have given no guidance on how the concept of a collective investment scheme applies to ICOs. It's not clear from the Gibraltar proposals whether they will cover all utility tokens irrespective of whether they can be traded in the secondary market. We can compare this to Hong Kong, where currently virtual assets are regulated to the extent they fall within the definition of a security, but there's been little guidance from the regulators on the characteristics that are likely to make a token issued in an ICO, for example, an interest in a collective investment scheme. The proposed regulations on the promotion, sale and distribution of tokens will require adequate, accurate and balanced disclosure of information to enable anyone considering purchasing tokens in the primary market to make an informed decision. The regulations may prescribe what, as a minimum, constitutes adequate disclosure and in what form disclosures are made, for example, in a key facts document not exceeding 2 pages. The Gibraltar FSC may publish guidance on the disclosure rules from time to time. As for financial crime provisions, undertakings that receive, whether on their own account or that of another person, proceeds in any form from the sale of tokens were brought within the scope of the Proceeds of Crime 2015 Act by an amendment which took effect in March 2018. Token issuers are therefore already under a statutory obligation to perform AML and CTF checks on token purchases. Let's take a closer look at the proposed concept of authorised sponsors. The proposed regulations will establish a regime for the authorisation and supervision of token sales sponsors. They're called authorised sponsors, who will be responsible for ensuring compliance with this limb of the regulations. An authorised sponsor will need to be appointed in respect of every public token offering promoted, sold or distributed in or from Gibraltar. Authorised sponsors may be appointed by the Gibraltar promoter or by organisers of the offering, wherever located. Authorised sponsors will be required to have knowledge and experience of ICOs and mind and management in Gibraltar. They will be allowed to delegate some of their work to others, including offshore parties, but will remain directly accountable to the GFSC for the actions of their delegates. Under the proposed regime, authorised sponsors will be required to have in place one or more codes of practice relating to offerings they sponsor. authorised sponsors are considered to be in the best position to determine best practice for the offerings they sponsor and will be free to apply different codes to different categories of tokens and offerings. Codes of practice may cover matters such as methods for applying and distributing sale proceeds. A code of practice will have to be incorporated in authorised sponsors agreements with their ICO clients. Submission of codes of practice will form part of the application process for an authorised sponsor licence. Prior reporting of amendments to codes of practice will be required and will be treated in the same way as other major business changes. It's proposed that regulations would specify principles governing the content of codes of practice. Authorised sponsors will be free, subject to approval, to set their own methodologies for implementing the principles. The GFSC will establish and maintain a public register of authorised sponsors and their codes of practice, past and present. The GFSC will add to the public register the following details of public offerings provided by authorised sponsors of public offerings that are engaged in the clients for whom they act, the tokens included in an offering, the code of practice applicable to the offering, and any interest they and connected persons have in the tokens offered. A new controlled activity of being an authorised sponsor is proposed, and it will be an offence to promote, sell or distribute tokens in or from Gibraltar without compliance with the requirement for an authorised sponsor, the requirement for a current entry on the public register, specified disclosure obligations and relevant provisions of POCA where applicable. The promotion, sale and distribution of a public token offering may only be conducted once and while the offering appears on the register. The proposals do include regulation of secondary market platforms operated in or from Gibraltar that are used for trading tokens and, to the extent not covered by other regulations, their derivatives. The regulations aim to ensure that the activities of these markets are fair, transparent and efficient, and that organised trading occurs only on regulated platforms. The proposed regulations will set out requirements for disclosure to the public of data on trading activity, disclosure of transaction data to the GFSC, and specific supervisory actions concerning tokens and positions on token derivatives. These regulations will cover secondary market trading of all tokenized digital assets, including virtual currencies, and will be modelled to the extent appropriate on market platform provisions under MiFID II and the Markets in Financial Instruments and Amending Regulation. The proposals include adding a new controlled activity of operating a secondary market platform used for trading tokens and their derivatives. The GFSC will authorise and supervise secondary token market operators and maintain a public register of such operators. The proposed legislation would include a new controlled activity of providing investment and ancillary services relating to tokens in or from Gibraltar and, to the extent not covered by other regulations, their derivatives. The limb of the regulations is intended to cover advice on investments in tokens, virtual currencies and central bank issued digital currencies, including generic advice, setting out fairly and in a neutral manner the facts relating to token investments and services. Product-related advice, setting out in a selective and judgmental manner the advantages and disadvantages of a particular token investment and service. And a personal recommendation based on the particular needs and circumstances of the individual investor. This limb of the regulations will be modelled on similar provisions under MiFID. The proposals are planned to be implemented through amendments to Gibraltar's Financial Services Investment and Fiduciary Services Act 1989. Before turning to an overview and analysis of recent developments in the market generally, I'm first going to touch on the EU's proposed legislation known as the Regulation on Markets in Crypto Assets, a framework which will be seeking to regulate EU crypto assets and service providers. I'm then going to discuss some recent developments, such as PayPal's crypto rollout, the DBS digital exchange, and a few others. The EU's proposed framework for crypto assets was announced on the 24th of September 2020 as part of the EU's digital finance package, which aims to enhance the competitiveness of the fintech sector in the EU and seeks to regulate crypto assets that currently fall outside the scope of the EU's regulatory regime to provide for a single licensing regime across all member states. The proposed framework is particularly notable given that, if adopted, it will create the most significant regulated space for cryptocurrencies in the world, in addition to subjecting stablecoin issuers to enhanced regulation. So let's look at the proposed framework in more detail. Which crypto assets will be caught by the regime? Crypto assets are defined in the MiCA as a digital representation of value or rights which may be transferred and stored electronically using DLT or similar technology. Broadly speaking, the MiCA will apply to any crypto assets that are not already subject to EU regulation, meaning that crypto assets which qualify as financial instruments, that's security tokens which are already subject to EU financial services regulation, and e-money subject to the EU's e-money directive, will fall outside the scope of the MiCA. Crypto assets which qualify as deposits, structured deposits, and securitization will also not fall within the scope of the MiCA. The MiCA will therefore regulate the likes of utility tokens, defined as a type of crypto asset intended to provide digital access to a good or service available on DLT and accepted only by the issuer of that token. Stablecoins, also known as asset reference tokens and e-money tokens, which are tokens which do not fall within the definition of electronic money. Asset reference tokens are defined as a type of crypto asset that purports to maintain a stable value by referring to the value of several fiat currencies that are legal tender, one of several commodities, or one of several crypto assets, or a combination of these assets. An e-money token is a crypto asset whose main purpose is use as a means of exchange and that purports to maintain a stable value by referring to the value of a single fiat currency. This would include USDC, the stable coin issued by Circle, which is backed by US dollars. There's also a specific mention of significant stable coins, which will include global stable coins, such as perhaps Facebook's Libra. The scope of the MiCA is further broadened with the catch-all definition of other crypto assets, which is intended to cover all other crypto assets such as Bitcoin and Ether, which are not covered by other regulatory regimes. How would the MiCA apply in terms of the provision of crypto-related services? Well, the scope of services which would be caught by the regulation are broadly similar to existing regulated activities under EU law, and would include trading platform operators, custodial services, and exchange service providers, including crypto-to-crypto exchange, fiat-to-crypto, and vice versa. It would also cover the placement of crypto assets, executing payment transactions in asset reference tokens, and providing advice on crypto assets. The proposed regime would only allow crypto asset services to be provided by a legal person with a registered office in an EU member state, and that legal person would have to be authorized and licensed in an EU EEA member state as a crypto asset service provider. The authorization will be passportable, meaning that services can be provided throughout the EU once authorized in a member state. In order to obtain a crypto asset service provider license, an entity will need to meet requirements similar to those applicable to financial service providers, including capital requirements, organizational requirements, and conduct requirements. As for issuers of crypto assets, the MiCA adopts a broad definition of any legal person who offers to the public any type of crypto assets or seeks the admission of crypto assets to a trading platform for crypto assets. Certain requirements will be imposed on those falling within the definition of an issuer, including that an issuer must be a legal entity. The requirement to establish a legal entity to provide crypto asset services is aimed at providing investors with an identifiable party against which they may seek redress. Issuers will also be subject to minimum disclosure requirements. That is, they must publish a white paper which satisfies certain minimum content requirements, similar to the requirements under the EU prospectus regulation, and complies with the requirement that disclosures are fair, clear, and not misleading. In the case of issuers of asset reference tokens, stablecoins, they will be further required to seek authorization. The MiCA will impose liability on the issuer for damages in the case of failure to meet the requisite standards. Issuers must also comply with the requirements set out in Article 13 of the MiCA, which broadly relates to conduct and communication requirements, conflicts of interest, and security. In the case of stablecoins or e-money tokens, the requirements are far more far-reaching. Issuers of e-money tokens and asset reference tokens will have to be established in the EU. Issuers of e-money tokens will also be required to be authorized as an e-money issuer under the e-money directive, and issuers of stablecoins will be required to be authorized under the MiCA. Exemptions are available from the authorization requirements for both e-money token issuers and asset reference token issuers for small-scale offerings of up to €5 million within 12 months and offerings solely to qualified investors. There's no requirement for issuers of general crypto assets to be established in the EU. MiCA will also introduce more stringent requirements and enhanced supervision requirements for significant asset reference tokens and significant e-money tokens. Issuers of significant e-money or asset reference tokens will be subject to a higher capital requirement of up to 3% of reserve assets and will have to put in place a liquidity management policy. The assessment of whether a particular token is significant will be made by the European Banking Authority, having regard to factors such as the market cap or value of at least €1 billion, having at least 2 million customers, and being used in at least 7 EU member states. If adopted, MiCA would apply across the EU to all member states and would be directly applicable, meaning implementation at a national level would not be required. In addition, firms outside the EU would be impacted to the extent that they do business within the EU. Issuers seeking to issue stablecoins or e-money tokens in the EU would therefore be required to be established in the EU and be duly authorized. In terms of timeline, it's been tentatively suggested that the proposals will take up to 4 years to be formally adopted in EU legislation. This is taking into account the legislative process, which may take up to 1 to 2 years, and an 18-month transition period for authorization, as indicated in the proposals. As I've touched on, there are a handful of European nations which have pushed ahead with innovative frameworks to capture the opportunities in the crypto sphere. However, there's no overarching regulatory regime, which is in some ways at odds with the cross-border nature of many crypto businesses. This was a concern for some startups in the crypto space, with some relocating from Europe to more favorable regulatory spaces in Asia. This fragmented approach in the EU was one of the key motivating factors behind the proposals, and in particular the passporting provision, as identified by the Vice President of the European Commission, who indicated that fintechs are facing many barriers to exploring the full potential of the single market. Looking ahead, one of the key benefits of the proposed framework would therefore be access to a new EU single market for crypto assets. We can draw comparison to the Asia-Pacific region generally, where a broadly similar picture has emerged. We've seen a patchwork of regulatory approaches evolve, ranging from mainland China's prohibition outright in some areas to Japan's more progressive legislative efforts, which have been welcomed by the crypto industry. Hong Kong, as I've mentioned, lies somewhere in the middle, as regulators try to strike a balance between risk management and investor protection on the one hand and ensuring innovation is not stifled on the other. Therefore, generally speaking, those operating in the crypto sphere in the EU and Asia-Pacific face the same main challenge: knowing, understanding, and complying with the restrictions, requirements, and obligations from jurisdiction to jurisdiction. Of course, Asia-Pacific is not directly comparable to the European Union, given that there is no comparable economic and political union of that scale in the APAC region. However, that's not to say that a coordinated or harmonized effort wouldn't be possible. For example, as I've mentioned, this is to a more limited extent what the FATF recommendations are seeking to accomplish. As for the legislative efforts in Europe and how they differ from Asia Pacific, the main distinction is pace. Broadly speaking, regulatory efforts in Asia have gained momentum over the past few years, and we've seen APAC emerge as a hotbed for digital innovation. Many queried whether we would see this momentum replicated in Europe, and it seems that with the EU proposals there is some potential. On the other hand, concerns have been raised that the EU proposals favour incumbent financial institutions over fintech startups, and so it remains to be seen whether the framework will strike the right balance between fostering innovation and mitigating risk, a balance which can all too easily be thrown off by over-regulation or barriers to entry set too high. This is a familiar concern in Hong Kong, a concern which has re-emerged in the light of the FSTB proposals, particularly the proposed prohibition on virtual asset exchanges servicing retail investors. Co-founder of the Bitcoin Association of Hong Kong, Leo Wies, has complained that the move would overshoot the Hong Kong government's goal of promoting innovation and financial inclusion. Now turning to some recent market developments in the crypto sphere. First, PayPal. I previously touched on PayPal, allowing US users to buy, sell, and hold cryptocurrencies directly through their PayPal accounts. By way of an update, it's been forecast that PayPal's overall revenue will increase by 20%, with earnings of approximately $2 billion US from its Bitcoin business alone by 2023. Demonstrative of this scale of interest in PayPal's newest feature is that Bitcoin traders have been found to be using the PayPal app 3 times as much as non-Bitcoin users, with the former having significantly higher cash balances in their PayPal digital wallets compared to other users. Interestingly, Hong Kong's most recent development, the proposed retail ban, is very much at odds with PayPal's latest move. The recent licensing of crypto exchange OSL Digital Securities, a platform which will be restricted under the terms of its license to serving institutions and professional investors, is a case in point. Regulation is causing Hong Kong's crypto market to shift away from the retail market, and this will only increase when the FSTB's proposed regime for licensing exchanges which trade virtual assets that are not securities comes into force. The benefit of regulation is that it can give institutional investors the comfort they need to enter the crypto market. On a similar note, Southeast Asia's largest lender, DBS, announced on the 10th of December 2020 that it would be setting up the DBS Digital Exchange, the first digital exchange for trading fiat money and cryptocurrencies with backing from a traditional bank. The announcement followed its receipt of in-principle approval by the Monetary Authority of Singapore, recognizing the DBS Digital Exchange as a recognized market operator. The DBS Digital Exchange will provide a regulated platform for the issuance and trading of digital tokens backed by financial assets, cryptocurrency trading and exchange services between 4 fiat currencies, including Hong Kong dollars, and 4 of the most established cryptocurrencies, Bitcoin, Ether, Bitcoin Cash, and XRP, and digital custody services. The DBS Digital Exchange will only offer services to institutional investors and accredited investors. The entry of traditional banks and payment services platforms into the crypto sphere is an indication that traditional players are recognizing the potential of cryptocurrencies. This is also evident when looking at the surging levels of institutional interest, with institutional investors injecting around $429 million into crypto funds and projects for the week ending 7th of December 2020, the second highest record to date. DBS's move is also an indication that regulators in the Asia-Pacific region are becoming increasingly confident of handling crypto and crypto-related trading. DBS's announcement came just before Hong Kong's licensing of OSL Digital Securities, which is reportedly also applied for a digital asset license with the Monetary Authority of Singapore under the Payment Services Act. In a further suggestion that institutional interest in crypto is on the rise, BlackRock, the world's largest asset manager with around $7.8 trillion in assets under management, is reported to be looking at giving 2 funds the go-ahead to invest in Bitcoin futures, according to prospectus documents filed with the US SEC on the 20th of January 2021. This would be BlackRock's first step into the crypto market. However, there had previously been indications that the move was under consideration. In November 2020, BlackRock's CIO for fixed income said that crypto was here to stay and could even replace gold to a large extent. This sentiment was echoed by BlackRock's CEO, Larry Fink, who in 2020 acknowledged the potential for Bitcoin to turn into a global market asset. And according to a recent report published on the 21st of January 2021 by trading platform eToro, which quizzed 25 big institutions in the third quarter of 2020, more and more asset managers, even the most risk-averse such as pension funds and endowments, are looking at crypto as an asset class, with many suggesting that the crypto market had matured considerably over the past 2 years, with the time now being right to get involved. This trend is somewhat recognizable in Hong Kong too, where we've seen OSL receive its license and the first approved crypto fund, Arano, launch in April 2020, targeting institutional investors. Whether we'll see more institutional investors move into the crypto space in Hong Kong remains to be seen. However, we are most certainly entering a new era of growth. So I think that brings us more or less to the end. Thank you very much for joining me today. A final word, as I mentioned earlier, this is the last part of a 7-part webinar series. It's been my honor to deliver these webinars to you over the past few weeks. Thank you for joining me today. And for some of you, thank you for joining me also over the past few weeks. I wish you all the very best and hope to see you again with future updates later this year. Have a great weekend.